Most people wake up every morning and check the same things. Stock indices hitting new highs, flashy headlines about AI, tech earnings, or whatever is trending that week. It feels reassuring, almost comforting, like everything is under control. But while attention is glued to the surface, something far more important is happening quietly underneath. And history has a funny habit of punishing anyone who ignores the quiet parts. Let's start from a different angle. Markets don't usually break when everyone is screaming. They break when the plumbing starts failing and hardly anyone notices. Right now, that plumbing is the physical precious metals market, and it's making noises that seasoned observers have learned not to ignore. Not panic noises, not meme stock chaos, but the slow, uncomfortable creak of a system being stressed in places most people never look. In late January 2026, a corner of the financial world most investors have never interacted with directly sent up one of those signals. The silver futures market saw a surge in delivery requests that simply does not happen in normal times. We're not talking about traders flipping contracts for a quick profit. We were talking about actual demands for metal to be taken out of vaults and delivered into real-world possession. On one Tuesday morning alone, nearly 80 silver delivery notices were issued. That might sound abstract, so let's ground it in reality. Each notice represents a futures contract, and each contract equals 5,000 ounces of silver. By the time January closed, nearly 9,700 contracts had stood for delivery. Do the math, and you land at roughly 48 million ounces of physical silver demanded in a single month. To put that in perspective, a typical January might see 1 to 3 million ounces delivered, sometimes even less. Spikes do happen occasionally, but nothing remotely close to this scale. This wasn't a rounding error. It wasn't a seasonal quirk. It was more like 16 times normal volume, arriving all at once, without warning and without a neat explanation. This is where understanding how futures markets usually function becomes crucial. Most futures contracts never result in physical delivery. They're closed out, rolled over, or settled in cash long before expiration. That's not a flaw, it's how the system is designed. The entire structure relies on the assumption that only a small fraction of participants will ever want the actual commodity. Paper promises circulate freely because, historically, very few people knock on the vault door and ask for the real thing. But when that behavior changes, the implications are serious. Large financial institutions don't accidentally request delivery. They don't do it on a whim. And they certainly don't do it in quantities that draw down vault inventories unless they have a reason. These are entities that understand counterparty risk, settlement risk, and the subtle difference between owning a claim and owning an asset. The uncomfortable truth is that choosing physical delivery over cash settlement is a vote of no confidence in the paper system. It says, quietly but clearly, I'd rather hold the metal than trust the promise. When that mindset spreads, even among a small group of well-capitalized players, it starts to strain a system built on the opposite assumption. At the same time this delivery surge was unfolding, silver prices were trading north of $115 per ounce, a level that would have sounded absurd not too long ago. But here's the key point. Price isn't the headline. Price is just the symptom. The real story is the behavior behind the scenes. High prices usually discourage delivery. They encourage profit-taking, cash settlement, and speculation. What we're seeing instead is elevated prices paired with aggressive physical demand, which is not how a relaxed, well-balanced market behaves. Inside the exchange vaults, silver is categorized into registered and eligible inventory. Registered metal is available to meet delivery obligations. Eligible metal is stored but not committed for delivery. When delivery requests accelerate, registered inventories shrink. The cushion between paper claims and physical reality gets thinner. At some point, the numbers stop working in theory and start colliding with reality. If this pace of delivery continues into the following months, the math becomes unforgiving. There simply is an ET. Enough registered silver to meet sustained demand at these levels without either reclassifying eligible metal, incentivizing holders to part with it at higher prices, or changing the rules of the game. None of those outcomes are particularly comforting if you believe markets are supposed to function smoothly and transparently. We've seen versions of this movie before. A few years ago, another metal market faced a sudden delivery crisis. Trading was halted, contracts were retroactively adjusted, and losses were socialized in the name of orderly markets. Official explanations were polished and reassuring. The underlying issue was not. There wasn't enough physical supply to honor the paper commitments as written. Silver is not that market. It's larger, more liquid, and far more strategically important. But the principle doesn't change. When claims multiply faster than physical supply, something eventually gives. Either prices reprice violently to ration demand, or confidence in the mechanism itself begins to fracture. Now zoom out for a moment, because this isn't happening in isolation. While silver is being quietly pulled out of vaults, the broader financial landscape is flashing its own warnings. The currency underpinning the global system has just posted its worst annual performance in nearly a decade. Central banks are adjusting policy in ways that signal concern. not confidence. Public debt continues to expand faster than growth, and real yields remain a source of tension rather than stability. Some veteran market voices have gone so far as to suggest that the stresses building now could eclipse those seen during the global financial crisis. That's not a prediction, it's a reminder. Crises don't announce themselves politely. They develop in corners most people aren't watching, then spread once it's too late to reposition calmly. What makes this moment especially interesting is the contrast. Equity markets are celebrating. Headlines are optimistic. Risk appetite appears strong on the surface, and yet beneath that optimism, a subset of participants is quietly converting paper into metal, claims into custody, and abstractions into weight. That divergence should make any serious observer pause. This doesn't mean the system collapses tomorrow. It doesn't mean every futures contract fails or vaults suddenly empty overnight. Markets can stretch longer than logic suggests. But it does mean that trust, the invisible glue holding paper markets together, is being tested in subtle ways. And trust, once questioned, is very hard to restore. There's a temptation to dismiss all of this as niche, irrelevant, or overly dramatic. Silver isn't flashy. Vault inventories don't trend on social media. But real wealth has never been built by following what's loud and popular. It's built by recognizing patterns early and understanding what behavior reveals when words are carefully chosen. A bit of humor helps keep perspective, of course. Nobody is suggesting people start bartering silver coins for groceries tomorrow. But ignoring the signal because it's inconvenient or boring has historically been a losing strategy. The markets that matter most are often the ones nobody's talking about at dinner parties. So when you see record delivery demands, institutional players choosing possession over settlement, and a currency system under visible strain, it's worth connecting those dots. Not to panic, not to predict doom, but to understand that something is shifting. And shifts once underway rarely move in straight lines. The real question isn't whether this matters. It's how long it takes before everyone else realizes it does. Markets usually force change in one of two ways. Either prices move enough to correct behavior, or the structure itself bends until it breaks and reforms. What the delivery data from January 2026 is showing us is that some very large, very sophisticated players are actively probing which of those outcomes is coming next. And they're doing it quietly, without press releases or dramatic announcements. At prices hovering around $150 per ounce, silver is already well beyond levels that, in theory, should cool things down. High prices are supposed to discourage hoarding, encourage producers to sell, and push market participants back toward paper settlement. That's how the textbooks say it works. But textbooks don't always survive contact with reality. Despite these prices, delivery notices keep coming. Vault inventories keep shrinking. The flow of metal out of the system is accelerating, not slowing. That alone tells you something important has changed in how risk is being assessed. For the institutions demanding delivery, possession clearly matters more than convenience right now. They're willing to absorb storage costs, accept reduced liquidity, and deal with logistical friction because, in their assessment, the risk of holding a paper claim has risen above the cost of holding the metal itself. That's not an emotional decision. That's a calculated one. It suggests they see value in silver that is in T fully captured by its quoted price, and danger in the broader financial backdrop that makes physical ownership feel like insurance rather than speculation. Zoom out, and the context becomes even more interesting. Silver isn't acting alone. Gold has been climbing in near parabolic fashion. At the same time, equity markets are sitting at record highs, celebrating optimism, growth narratives, and policy support. Meanwhile, the Federal Reserve is preparing for another policy decision, and the US dollar has just logged its weakest annual performance in 8 years. These developments don't exist in isolation. They're part of the same story, even if most market participants are reading them as separate chapters. Something unusual is happening in global markets, something that doesn't fit neatly into traditional economic frameworks. Precious metals are surging, stocks are surging. Normally, these assets take turns. One rises when fear dominates, the other when confidence returns. But here they are, climbing together. Fear and greed, moving in sync instead of opposition. That's not supposed to happen, at least not according to conventional wisdom. When relationships like that break down, it usually means the underlying variable has shifted. In this case, that variable is trust in the currency itself. The dollar didn't have a bad year because of a single shock or crisis. It weakened through a series of deliberate choices. Public comments from policymakers made it clear that dollar strength was no longer a priority. In fact, flexibility, even weakness, was framed almost casually, like something to be adjusted when convenient. A weaker dollar serves very specific objectives. It makes exports more competitive. It narrows trade gaps. It inflates nominal GDP figures, making growth look stronger on paper than it might be in real terms. And perhaps most importantly for markets, it pushes asset prices higher. Stocks, real estate, commodities, all priced in dollars, tend to rise as the currency falls. On the surface, it looks like prosperity. Underneath, it's monetary inflation wearing a nice suit. Markets, of course, love this. Indices climb. Balance sheets look healthier. Everyone feels a little wealthier, at least until they try to convert that wealth into purchasing power. And this is where the more skeptical voices come in. Some economists have warned that the stresses building now could surpass those of the last major financial crisis. These warnings are easy to dismiss when markets are rising. They always are. But they're not based on vibes or sentiment. They're based on structure. The crisis years ago didn't eliminate debt. They relocated it. Private debt became public debt. Bank balance sheets were stabilized by central bank intervention. Interest rates were pushed down, and liquidity flooded the system. Those measures bought time, but time doesn't solve structural imbalances. It just allows them to grow. Nearly 2 decades later, government debt is dramatically higher, corporate leverage is widespread, consumer debt continues to climb, and the policy toolkit hasn't changed. It's still rate cuts, stimulus, and currency expansion. All roads lead back to the same mechanism: more currency units, representing the same underlying value. On the very day that nearly 48 million ounces of silver were demanded for delivery, the Federal Reserve held a key policy meeting. The timing wasn't lost on anyone paying attention. Rate cuts, when they arrive, are framed as support, but they also signal fragility. They tell you the system can't handle tighter conditions. They penalize savers, reward borrowers, and push capital toward assets rather than productivity. This is where the pieces lock together. Smart money isn't choosing between stocks and metals. It's buying both. It's not betting on a market crash. It's hedging against currency risk. The real fear isn't that equities implode tomorrow. The real fear is that the unit of measurement itself keeps losing credibility. When inflation data recently came in lower than expected, markets cheered. Lower inflation should strengthen the currency and reduce demand for hard assets. Instead, precious metals accelerated higher. That divergence tells you everything you need to know about how sophisticated investors view official data. Inflation metrics capture selected price changes, adjusted by shifting formulas and assumptions. They don't capture monetary expansion. They don't capture asset inflation. And they certainly don't capture the lived experience of declining purchasing power. The drawdown in exchange vaults is a silent vote of no confidence. Not in innovation, not in corporate earnings, but in the reliability of paper promises. When institutions choose physical delivery at this scale, they're making a clear statement about counterparty risk. They're saying the promise is no longer enough. The metal matters more. All of this is happening at once. Weak currency policy, historic delivery demand, surging metals, elevated equity markets. That kind of convergence doesn't happen by accident. It usually marks the early phase of a transition, not the end, but the beginning. Monetary regimes don't collapse overnight. They fray slowly, then suddenly. Every financial system runs on faith. Faith that contracts will be honored. Faith that settlement will occur. Faith that paper corresponds to reality. Until one day, under enough stress, that faith gets tested. Futures exchanges were never designed for mass delivery. They were built for hedging, price discovery, and liquidity. Historically, less than 3% of silver contracts ever resulted in physical delivery. The rest were settled in cash. The system works because that behavior stays consistent. January 2026 broke that pattern. When thousands of contracts stand for delivery in a single month, when delivery rates surge far beyond historical norms, the structural assumptions start to crack. Exchange inventories are divided into registered metal, available for delivery, and eligible metal, which belongs to private owners and isn't committed. As registered supplies shrink, the system depends on those private holders voluntarily stepping in. That's not guaranteed, especially when holding metal feels safer than releasing it. Project this forward a few months, and the tension becomes obvious. If demand continues, inventories approach levels that can't comfortably support the market. At that point, the exchange faces choices no one likes to talk about. History suggests what those choices look like. When a market threatens systemic stability, rules get rewritten. Trading halts, settlements change, contracts are honored selectively in the name of order. This isn't speculation. We've seen it happen before in other metals. The details differ, but the principle is consistent. When forced to choose between strict contract enforcement and protecting the system, exchanges protect the system. That's not moral judgment. It's operational reality. Silver isn't there yet. But January made something very clear. The stress is real. The behavior has changed. And once behavior shifts at the institutional level, it rarely snaps back quietly. If you really want to understand what January was about, you have to look past the raw numbers and focus on who was doing what. Numbers alone can lie by omission. Behavior rarely does. The actions taken by major clearing institutions during the delivery process were not accidental, not symbolic, and definitely not routine. When one institution issues delivery notices, It's stepping forward to supply physical metal against short positions. When another stops delivery notices, it's choosing to receive that metal against long positions. Both sides require something very real to happen. Silver has to move. Vault doors open. Bars change ownership. This isn't spreadsheet trading. It's logistics, custody, and possession. In January, one major institution issued dozens of delivery notices while another took even more. That positioning matters. It shows that the same players who helped build and dominate the paper-silver market are now actively participating in draining physical metal from the system. When the architects of a system start hedging against it, you pay attention. They're not guessing. They're managing risk they can already see forming. This behavior sends a clear message. Paper claims are no longer being treated as equivalent to physical metal. The difference matters now. There is concern, whether publicly stated or not, that contracts may not be honored cleanly, or may be settled under conditions that don't reflect true supply and demand. Converting paper into metal, while the option still exists, becomes the rational move. Not dramatic, just prudent. Industrial users are coming to a similar conclusion, but from a different angle. For manufacturers that rely on silver, this isn't an investment discussion. It's a survival one. Electronics, solar panels, medical equipment, advanced sensors, silver isn't optional in these processes. If supply tightens or if physical premiums detach from futures prices, production schedules get disrupted fast. Some companies have already adjusted. They're building inventories well ahead of immediate needs. 3 months, 6 months. In some cases, a year's worth of silver on hand. Yes, storage costs money. Yes, it ties up capital. But compared to shutting down a production line or missing delivery obligations, it's cheap insurance. This behavior feeds back into the system. Every ounce pulled forward tightens future availability. Every precaution taken makes the next precaution more logical. That's how stress builds in paper markets. Not through panic or headlines, but through quiet, rational decisions stacking on top of each other. Each participant acts defensively. Collectively, those actions strain the system. The moment participants realize claims exceed reality, confidence doesn't vanish overnight. It erodes steadily, then all at once. We're already seeing early signs of this erosion through geographic pricing anomalies. Silver doesn't trade at a single global price when physical constraints appear. Premiums emerge. Shanghai trades above New York. London diverges from both. In a perfectly functioning market, arbitrage would close those gaps immediately. Buy where it's cheap, sell where it's expensive, move the metal, pocket the difference. When those spreads persist, it tells you something is blocking that process. That blockage can be logistics, regulatory friction, vault availability, or outright reluctance to part with physical inventory. Whatever the cause, it means location suddenly matters. Jurisdiction matters. Possession matters. Theory gives way to reality very quickly when trucks, ships, vaults, and paperwork enter the picture. All of this is unfolding just as one of the historically largest silver delivery months approaches. March has always been significant. This year, it's being watched like a hawk. Will delivery demands remain elevated? Will registered inventory hold up? Will the exchange quietly introduce new rules, higher margins, position limits, or emergency clauses? These aren't academic questions. They're active scenario inputs for institutions right now. Because if delivery cannot be satisfied cleanly, the implications don't stop with silver. Futures markets across commodities are built on the same foundation. Confidence that paper contracts represent something real. Oil, copper, agricultural products all rely on that assumption. A visible fracture in one market invites scrutiny in all of them. Contagion doesn't require collapse. It only requires doubt. The reason sophisticated capital is acting now is simple. They don't wait for confirmation. They move while optionality still exists. Vaults still have inventory. Contracts are still being honored. Conversion is still possible. The question no one wants to answer out loud is how long that remains true. Markets don't ring bells at turning points. They whisper. January's delivery data wasn't an ending. It was a signal, and signals matter most before they're widely understood. From here, the discussion shifts from observation to response. Not prediction is a trap, but preparation. In complex systems, certainty is rare. Scenario planning is mandatory. Right now, 3 broad outcomes sit on the table. The first is the least disruptive. Delivery demand stays elevated through early 2026. Registered inventories decline but don't collapse, and prices rise high enough to discourage further physical conversion. Silver pushes higher, maybe well beyond recent levels until the economics shift. Speculators back off. Physical and paper realign. The system survives, bruised but intact. The second scenario is more uncomfortable. Delivery demands overwhelm registered supply. The exchange invokes emergency mechanisms. Contracts are modified or settled in cash under disputed terms. Legal challenges follow. Trust in futures markets takes a hit that doesn't heal quickly. Physical silver trades at persistent premiums. 2 markets emerge, one for claims, one for metal. The third scenario is the tail risk few want to contemplate. Stress in silver spreads to other commodities. Physical hoarding accelerates, supply chains strain, authorities respond with interventions that further weaken currencies. Confidence in the broader monetary framework erodes. The issue stops being about silver and starts being about money itself. Each scenario demands different decisions. For institutional portfolio managers, the immediate task is exposure clarity. What form does precious metals exposure actually take? Physical bars, allocated vault holdings, exchange-traded products, futures contracts, mining equities. Each carries different risks, especially when counterparty trust becomes the variable. Physical holdings reduce counterparty risk but require verification. Allocated means allocated, not promised. ETFs vary widely in structure. Some allow physical redemption, others don't. Futures contracts are pure trust instruments. If rules change, exposure changes instantly, regardless of market price. Mining equities add leverage and operational risk, and they correlate with broader equity markets when stress rises. Corporate treasuries face their own version of this puzzle. For industrial users, availability matters more than price. Having silver at $120 is better than not having it at $90. That reality is driving inventory decisions that reinforce tightness. No one wants to be the company explaining to customers that production stopped because a metal on paper was in T available in reality. For individuals managing personal wealth, the calculus is simpler but no less serious. Physical ownership has costs and inconveniences. Paper claims have risks that are becoming more visible. The answer isn't all or nothing. It's diversification across forms, jurisdictions, and custody structures. No single point of failure, no blind trust in one mechanism. Monitoring matters too. Weekly inventory reports tell a story if you watch the trend, not the headline. Delivery notice patterns reveal intent before price reacts. Spot-to-futures spreads show stress. Geographic premiums expose friction. Central bank precious metal purchases reveal how monetary authorities themselves are thinking. Credit default swap pricing on major bullion banks offers early warnings no press release ever will. None of these indicators predict the future with certainty. Together, they reveal direction. And direction is enough to act prudently. At its core, what's happening isn't about silver alone. It's about faith. Faith that paper equals reality. Faith that contracts will be honored as written. Faith that systems designed for a different era can handle today's scale and leverage. History shows that when faith weakens, physical assets regain importance very quickly. Major financial shifts always look obvious in hindsight. In the moment, they look boring, technical, and easy to dismiss. Vault inventories, delivery notices, premiums, spreads. Not exactly cocktail party material, but these are the details that matter before headlines catch up. January 2026 may end up being remembered as just another stressful month that resolved itself. Or it may be remembered as the moment behavior changed permanently. Either way, the smart response isn't panic or prediction, it's preparation. Because those who move toward reality before everyone else rarely regret it. And those who wait for certainty usually discover that certainty arrives only after the window is closed.